My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today we have a very special guest zooming in from New Jersey, a gentleman who has a lot, and I mean a lot of experience in real estate and in business. He's been around this game for decades, at least 3 of them. He's started and built up and taken a company through IPOs and I believe $5 billion valuation or something crazy like that. So, Mr. Kenny Pasternak, welcome to the show. Great to have you.
Thank you. My pleasure to be on and maybe be part of the conversation in our industry.
Yeah, most definitely. So, Kenny, I gave a little brief overview of your background, but you can do it much better justice. So, can you give us the 30,000-foot perspective of?
Yeah. Well, I come from Wall Street and I was short credit stocks coming into 2010, and I wanted to own real estate, the actual hard asset, as kind of a second career. And I took a lot of my fortune and I started my own fund and I raised money from other investors. Fast forward, that was in 2008. We've done 110 transactions, about $4 billion. We've owned about 5 million square feet of office, 7,000 units, and we've contributed about $200 million of our own personal money in the $700 million we've raised to date. So that kind of takes you through the first 15 or 16 years. And we've averaged about a 2.5 equity multiple, and we have 40 employees and we have second generation players in our fund family. That probably going forward, and we're looking to double the size of our fund at the bottom of the market cycle that we're right now.
Well, that's what I'd like to talk to you a little bit about, Kenny, because you've seen a few different cycles. And what are your thoughts about where we're at right now, October 2025, as we're recording this, in the different asset classes that you're?
Well, we're mainly looking at either deep opportunity or multifamily that we can buy. We operate a lot in Florida, north of like Southeast Florida. So most of our holdings are there, about 60%. The other 40 are in the New York metropolitan region. They have 2 different dynamics going on right now. But Florida, we're able to buy 5-year or newer properties for below replacement costs, with a yield to cost higher than our cost of borrowing. We only see that at market bottom cycles. So we're excited. The second thing we see a lot of, very recently, there was a standoff between the buyers and sellers. They were in denial of how much value they've either lost or not made. Yeah. And they really didn't want to sell, but now they're having to sell typically because of variable rate mortgages or maturity defaults in their portfolio.
So what are you and your partners looking to do with this opportunity? What do you think the time frame is? What do you think the window of opportunity is?
Well, typically it's about 2.5 to 4 years. And it usually doesn't start till there's usually some sector change. That was around 2020, 21, 22. But it usually takes 2 years to like get through the denial period.
Yeah.
And 3 years to clean the mess up. And where to start. So we had a hard time buying properties in 22, 23. And in the last 18 months, we've bought around 1,500 units. And we presently own about 3,500 units. And we'd like to get to 10,000 at the end of probably another 3.5, 4 years. So we have a lot of work to do, but we're trying to buy about 2,000 to 2,500 units a year.
What's kind of your preferred buy box, Kenny? What do you guys, what's like beyond the numbers a little bit, but like what's the perfect kind of deal?
Well, we're really buying in markets that are oversold. ChatGPT is kind of interesting because we can do a lot of analysis, for instance, of the percentage to assess a few things that are numerical. Like we're looking for overbuilt markets where during 23 and 24, the new releases were about 2x the inward migration demand.
Yeah.
And that forced the rates down 10 to 20% in most cities, particularly Jacksonville, Daytona, Orlando, and Tampa, which are our 4 target areas right now. And so we're really modeling, again, that we can buy cheaper than our cost of capital with a higher yield. We can realize both normal kind of 4% inflation on a 5 to 7 year hold, and we can regain that 5 to 10, in some cases even 20% divergence from the mean. And when you add all that up, you're going to have 20 IRRs and a kind of a 2.5 or better equity multiple.
Nice. What's your exit strategy with these properties, Kenny?
And we sell a good portion of them in years 5 to 7, probably half. Our fund has a 5-year investment period and then a 5-year kind of come to the end. It's a 10-year term fund. We have a harvest period and a wind up period. And during the other 50%, some of them still have so much upside. We refi out. Historically, we've been able to refi 100% of our equity basis and more in many cases, return that capital, and then have a second bite of improving our gain on the unrealized gain.
Very nice. What was I going to ask you? I was going to ask you, we're talking a lot about multifamily, but you guys invest in a lot of different asset classes. What else are you seeing on the horizon outside of multifamily?
Well, there's a few other asset classes that in the last cycle, office was really cheap. We stayed away from that despite the prices being really low because we just don't see a demand barometer there.
Yeah.
But what we do see a demand barometer on unbelievable location land. We bought 1,000 acres of industrial in Jacksonville recently. Got it approved for 4 million square feet of industrial at about 25% of what land costs are by buying it pre-development at the bottom of the market cycle. Another kind of interesting study is we bought the second largest mall in Long Island for $41 million. It was appraised at $325 million about 15 years ago, but of course it was fully leased. Now it's 25% leased.
Oh.
And we're repositioning it as a lifestyle mall with big box where there's demand as opposed to a traditional covered mall with anchored department stores, which is really a model that doesn't work anymore.
Interesting.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So, but forgive me, but can maybe explain that a little bit more for me, if you don't mind, Kenny? So,
it's the Hicksville Mall in the middle of Nassau County, which is one of the 5 richest counties that only has 3 malls.
Okay.
It's the weakest mall, but best located in the center of about 2.5 very million wealthy people. It even has a train station to New York City. In the envelope, you can get to New York City in 25 minutes.
Right.
But it had a Macy's and a Sears, and I'm sure you heard these stories that just don't have viability anymore, that were dark. Yeah. And a lot of mid-range clothing stores that now the internet has really made them either difficult or obsolete. And we've depopulated admittedly, some of it was already depopulated. We've depopulated a good portion of the rest of the mall, and we're repositioning it for lifestyle, which includes activities like bowling alleys and movie theaters, a lot of food offerings in the remaining part of the mall. And then the big box part, we just signed BJ's to a 40-year lease.
Nice. Okay. Yeah.
And the BJ's rent, it's a ground lease. You could sell the lease on BJ's for more money than we pay for the whole mall.
That sounds like a hell of a good deal. So, Kenny, you've been in the whole capital space for decades and decades. A lot of our listeners and viewers and followers are basically just kind of getting started with raising capital and talking to investors and getting investors on board with their deals, typically a lot smaller than what you guys are doing. What advice do you have for up and coming real estate investors and capital raisers, kind of based on, decades of experience in the field?
Well, I used to give talks to MBA programs, and I'd say the 10 most important things in real estate. I had in my flashcards, and everyone had equity written on them. They'd go, "Oh, I could." And we always have a saying, many can buy and few can pay for it.
Mm.
So, I think they have to understand that that's a steep hill for a very early stage sponsor. And I think that you need to have sponsorship from somebody who knows you, either an ex-boss or relatives, to build a track record. To go out there and try to raise money without a track record, just based on, a pitch book that could be, in fact, really credible and even executable, won't really pass the muster with most investors who don't have an affinity. So I would really concentrate on that affinity, or I'd look for a partner who had sponsorship spots, and I would try to be the operator of a partnership. I think going out and raising money, even in crowdfunding or whatever, is just not realistic. But I think once you pass that hurdle, and you don't need a decade, but you need a handful of successes at somewhat of I wouldn't say an institutional level, but at least a co-owned level, which I would say like something that's worth more than $5 million.
Mm-hmm.
And maybe you raised $1 million or $1.5 million from friends and family. And then you proved out your ability to identify the right asset, write the right business plan, and frankly, execute it.
Mm-hmm.
Those are really the three elements. Once you've done that, I think you're on your way a little bit to being investable. A lot of people taking just because they can write a business plan and they know it'll work, by the way, that doesn't resonate with most investors without track record.
Yeah. Well said. Yeah, that makes a ton of sense. So at this stage in your career, Kenny, who are the kind of investors that you are looking for to partner with in your projects?
Well, we're really typically marketing to people who are 1 or 2 degrees of separation from us, and who were we had $250,000 minimum, but truth be said, we don't market to anybody under $1 million. And we raised $105 million in our last fund. We put in around $40 million to GPs, and we had 125 investors, but 20 of them were 90% of the capital.
Mm.
So we had like 75 investors that invested 125 to 500,000. And I'm not saying we want to democratize investing. We want to accept people, but it's not because we don't have a digital relationship, and we typically are making presentations, spending an hour or two. It's just not possible for us to market to smaller investors or non-accredited investors as much as we'd like to. But I would say, and we're starting to learn, I did a 90-second interview with somebody who had 20,000 followers when we were marketing our Caber 6. This might be a little bit of a pat in the back for you. You know why I'm doing the podcast. I got 400,000 views, and 20 people reached out on LinkedIn, and I got 8 investors.
Wow.
From a 90-second, essentially a podcast in a way, right? An interview. It was about the time of bank failures, where I have a lot of experience in saving banks and operating banks under duress about a year and a half ago. But when people heard I was in the real estate business, it was kind of interesting, the power, and that opened my eyes. And we're actually looking at using podcasts and social media and other types of ways to reach people who are more than 2 degrees of separation. And my guess is a lot of your audience and other sponsors who are on your platform know more. They're probably ahead of me when it comes to that.
Yeah, maybe. But it sounds to me like you're doing a combination of things. You mentioned early on in the interview that you use ChatGPT. So you're using artificial intelligence to help you find markets and analyze markets and look at opportunities. And it also sounds like you still like the old school meet and greet and show people your deal and pitch them in person kind of thing, if I was reading between the lines.
You are. I mean, my own background is that, in the 90s, I started a company called Night Trading, and I used what's now called AI to do away with market makers, and that became a $10 billion company. So I have a deep respect in my own history. That was 30 years ago, of how profound using computers and, high-end math analytics. And I wouldn't say I'm as lazy as the next guy, but if I could write a program to raise $700 million, I'd probably, wouldn't say like it better. I do enjoy out there marketing and the satisfaction of selling myself. And even now I would tell your audience and sponsors, I have a lot of corny saying. And one is, if the monkey don't dance, the monkey don't get peanuts. And I go out just to test myself, because I think it's so inherent in our business, because you need equity. If you remember those flashcards.
Yeah.
That you need equity, that I challenge myself as an example to the other partners who I challenge to raise money. We have 7 partners here that are all under 50, about some of these corny sayings like the flashcard saying and the monkey don't, dance saying. And they're ever so true. If you want to be in the business, you have to develop a expertise, and frankly, look at it as a challenge, or even get to like it. But it's part of success here.
Yeah, and I guess certain monkeys dance better in person, and other monkeys dance online.
If I could do it with a digital avatar, or a spokesman like Wetter, right? Woody Harrelson, I'm open to anything that's creative. We talk about corny things, hiring a spokesman or using memes, and we may experiment with that in the next fund, because we're starting to think about things differently. And as you know, there's a lot of creativity and social media providers to teach you how to use not just chat, not just AI, but memes and everything from a TikTok visual to you name it, where you can connect with different types of communities of investors.
Yeah, very, very good. Well, Kenny, this has been fascinating. I'm sure there's going to be a lot of viewers and listeners interested in finding out more about you, perhaps connecting with you. If they do, where should they go?
Well, you could go to LinkedIn and email me. That's probably the easiest. Or, my email is kpast@chestnutcap.com. So you could, and our firm is called Caber Group. We have a pretty high web presence and a pretty good website that actually shows every asset we've ever bought, sold, or press releases and that kind of thing. And there's a Wikipedia site on me, if you can see if you want to find out how much of that I made out.
Sounds good, Kenny. Thanks so much for being on the show. It's been a lot of fun.
Thanks for having me.
All right, everybody, take care, and we will see you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.